Welcome to the Deep Dive. Today we are cutting through some serious noise and, frankly, confusion around the latest earnings call for Leslie's Inc.
That's ticker LESL.
Right. They're the biggest direct-to-consumer pool and spa care retailer in the U.S. And this call, it was an after-hours call, came after a really volatile day for the stock.
And the numbers they reported were, contradictory is the perfect word for it.
So our mission today is to figure out what's really going on. We need to unpack their new strategic plan, understand this huge gap between their official GAAP results and their adjusted reality.
And ultimately, we have to figure out why the market seems so skeptical about the whole thing. This is a story about a company taking some necessary pain, but facing, some real risk.
Let's just start with the headline number, the one that I think probably scared a lot of people. The Q4 diluted GAAP loss per share.
Oh, yeah.
A negative $17.54.
It's just a devastating number on its face, especially when you compare it to last year, which was a loss of just over $1.
So what on earth happened?
Well, this is where you have to peel back the first layer, that huge loss. It was almost entirely an accounting event. It wasn't really about the cash flow from the quarter's operations.
Okay, so not a cash loss.
No. It was driven by non-cash charges, specifically $183.8 million in Goodwill and store impairment charges.
In Goodwill impairment, that's just corporate speak for admitting you were wrong.
Right, it's admitting defeat. Exactly. Management is basically saying that all those high growth projections from years past, which were baked into the value of their assets.
The Goodwill.
Yep, that Goodwill, they're saying it's just not going to happen. They're wiping the slate clean of these, overly optimistic asset values.
So it's more than just an accounting cleanup.
Oh, it's a declaration. They're saying their past strategy is fundamentally dead, and that justifies the really drastic steps they're about to take.
Okay, so a huge, painful, but non-cash reset. But even if you strip that out, the picture wasn't exactly great.
Not at all.
The adjusted diluted EPS, that still only came in at 9 cents.
And that was a colossal miss. I mean, it fell nearly 92% short of the Zacks consensus estimate, which was $1.12.
So even operationally, severe underperformance on the profit side.
Undeniable profit compression. And if you look at the full year, you see the same story. A net loss of $237 million on sales that were down about 6.6% year over year.
But, and here's the contradiction. Sales for the fourth quarter actually beat expectations.
Right. This is the operational head fake.
Q4 sales were $389.2 million. That's down a bit, 2.2% year over year, but it still beat the consensus by about 5.6%.
And their adjusted EBITDA at $45.2 million was even slightly better than last year's Q4.
So how does that happen? How do you beat revenue when your core business is shrinking?
Well, their comparable sales were tanking. Q4 comps were down 6.5%, chemicals down 7.1%, equipment down 7.6%.
So people were buying less stuff.
Way less. The answer is that they found pockets of efficiency that kicked in before their new turnaround plan really started.
Meaning they got better at keeping the money from each sale, even with fewer sales.
You nailed it. Q4 gross margin actually expanded. It jumped to 38.6% from 36% a year ago.
Oh.
Better vendor rebates, lower freight costs. These are smart operational wins, but they're kind of giving this artificial profit boost that's going to disappear once the real strategy hits.
Which is price cuts.
Which is painful price cuts. They made more money per transaction, but they just didn't have nearly enough transactions.
Okay, that sets the stage perfectly for the turnaround plan itself.
Yeah.
Management was actually very candid about why this was all happening.
They were. They admitted to losing market share. They called it a price value challenge.
They got too expensive.
Basically, yeah.
Yeah.
Especially on core things like chemicals. And they put a really specific, painful number on it.
Which was?
They admitted to losing approximately 160,000 residential customers this year. Alone.
160,000. Wow.
And that single number, 160,000 pool owners walking away. That's the driver for this entire new strategy. They have to fix the price problem.
So you lose that many people because you cost too much. The obvious answer is you stop costing so much.
It is. They're committing to a major price reset, investing in lower everyday pricing on their key chemical products.
And they were upfront about what that's going to do to their margins.
Oh, yeah, crystal clear. They said this investment is going to compress their product gross margin by 100 to 150 basis points.
1 to 1.5% of gross margin.
Gone. Gone. They're trading margin for traffic. They know they have to get people back in the door, even if it hurts the profitability in the short term.
But wait a minute. If they lost 160,000 people over price, are they just going after those specific people, or is this a broader price war?
That's a great question, and it really gets to the clever part of their plan. They're using their customer data.
From the loyalty program.
From their Pool Perks loyalty program, yeah. It captures something like 85% of all their transactions, so the data is incredible. They're using it for what they call precision-targeted marketing.
So they're not just cutting prices for everyone.
No, that would be financial suicide with their balance sheet. Instead, they're targeting those 160,000 lapsed customers specifically and offering them the competitive pricing.
That's smart. So they don't have to give discounts to their loyal customers who are already willing to pay more.
Exactly. It's a really efficient way to use a margin sacrifice. You aim to win back the volume that left without totally destroying your margin structure.
Okay, so if part one of the plan is subtraction cutting, margin part two has to be finding the money to pay for it.
And that's where the asset utilization plan comes in.
Which, as we said, is just corporate speak for shutting things down.
That's exactly it. The core of it is store rationalization. They're planning to close 80 to 90 underperforming stores.
80 to 90. And what really jumped out at me was how little revenue those stores were actually generating.
It's tiny, only $25 to $35 million annually across all of them.
That's astonishingly low. It just shows you how unproductive they must have been.
It does. And the goal here isn't to save that revenue, it's to boost EBITDA. Closing these deadweight locations is expected to add about $4 to $10 million in annualized EBITDA.
And that money goes right into the pot to help pay for the price cuts.
Precisely. And they're attacking this from all angles. They're also getting rid of over 2,000 SKUs.
2,000 different product lines.
Yeah, mostly in their e-commerce long tail, stuff that just doesn't sell. And that's expected to add another $4 to $5 million in annualized EBITDA savings.
And they're optimizing the supply chain too.
Yep. They're moving to a more efficient 5 distribution center network. They've already closed their Denver warehouse, and an Illinois facility is closing in January. That alone is another $1 million in savings.
So the plan is pretty coherent. Get leaner, shrink the footprint, cut inventory.
They're targeting another $20 to $40 million in inventory reduction next year.
And use all those guaranteed cost savings to offset the painful but necessary price investment.
And while they're doing that, they're trying to improve service, expanding same-day delivery with Uber, for example. And I thought their internal restructuring was interesting.
The market leadership approach.
Yeah, integrating the local stores, service, commercial, and trade teams. It's critical because their advantage isn't really price. It's supposed to be expertise.
Right, the person in the store who can test your water and tell you exactly what you need.
And they have data on that. They said conversion rates after a water test actually went up 500 basis points this past year. So they know how to sell once you're in the door.
Their problem is just getting enough people to the door.
That's the whole game, which is why they're willing to take that margin hit.
So the strategy seems clear, it's aggressive, it's well articulated. But now we have to talk about the huge, scary elephant in the room.
A balance sheet.
The balance sheet. When you shift to the investor context, you enter this world of pretty severe distress.
This is the absolute core of the market skepticism. The company is flying deep in the financial red zone.
What's the biggest signal of that?
High leverage, for one. But the most telling number is their Altman Z-score. It's currently sitting at about 0.9.
Okay, for those of us who don't spend our weekends looking at credit risk models, what does a Z-score of 0.9 actually mean?
Think of it like a corporate fever thermometer for predicting bankruptcy. A score over 3 is safe. Anything under 1.8 signals severe distress.
So 0.9 is?
It means you are deep in the corporate intensive care unit. This makes fixing the capital structure mandatory, not optional.
And you can see how serious it is by the team they brought in. We're talking about big-name restructuring experts.
Oh, absolutely. When a company hires Kirkland & Ellis and Centerview Partners, firms that specialize in this exact kind of bet repair,
It's a huge red flag.
it signals that this is the #1 priority for the new CFO, Jeff White. This isn't just about tweaking debt. It could be about very complex negotiations under stress.
And this context makes their guidance for next year really, really important.
Highly scrutinized, yeah. For fiscal 2026, they're guiding sales between $1.1 and $1.25 billion.
And adjusted EBITDA between 55 and 75 million.
And critically, they said they expect to be free cash flow positive at the midpoint of that guidance, with CapEx held way down. But they also warned of serious headwinds in Q1.
Right, because they're coming up against a quarter from last year that was boosted by hurricane impacts.
Exactly. So they're trying to stabilize a severely stressed ship, fund an expensive price war, and navigate external headwinds all at once.
Suddenly, the market skepticism after the call makes a lot more sense.
It does. You have management laying out this clear transactional plan, but investors are betting on execution. The big fear is that the margin pain from the price cuts hits before the savings from the store closures fully materialize.
So it's a race against time and debt.
It's an execution race, plain and simple.
It's a really high-stakes bet on operational efficiency, which brings us to our final segment.
It does. And as always, a reminder, this is not financial advice.
Okay, so Leslie's is in the middle of this aggressive, highly leveraged restructuring. Success hinges on two things: executing the cost cuts and winning back those 160,000 customers.
And the trade idea here has to focus purely on the part they can control, the transactional cost out part, separate from the really uncertain pricing strategy.
The store closures and SKU cuts.
Exactly. Those are their control variables. If they can execute on that, they control that part of the narrative, at least for the short term.
So here's the pitch: a highly speculative leveraged long position, either in the equity or in short-dated call options, targeting mid-2026.
Right around Q2, when the store closures are supposed to be done.
And the thesis is what? Pure cost arbitrage.
It's purely transactional cost arbitrage. You've got $4 to $10 million in EBITDA uplift from the store closures, plus another $4 to $5 million from getting rid of SKUs. That's a minimum of $8 million in guaranteed EBITDA improvement.
And that $8 million is a pretty material chunk of their guidance. It's about 15% of the low end of their $55 million guidance for next year.
So if management just executes the closures on schedule, the stock, which is trading deep in this distress zone with that terrible Z-score,
You could see a big short squeeze.
a short squeeze, or just a multiple re-rating based purely on confirming those cost-out synergies. It's a bet that isn't dependent on winning back a single customer, just on their ability to shut down unprofitable operations on time.
A bet on subtraction driving survival.
That's it.
So to wrap this all up, Leslie's Q4 was defined by this core tension. You have a massive non-cash GAAP loss, a clear signal of past failures, but also this clear, immediate plan to stabilize the business.
Right. They're doing aggressive cost cutting to fund a painful but necessary investment in pricing to win back market share.
And the equity holders are now betting on whether the biggest player in the industry can pull off this radical contraction and re-engage customers, all while navigating this incredibly stressed balance sheet.
The cost cuts are the key. They have to fund the future growth strategy.
So the final thought for you, the listener, is this. What stands out more? The signs of operational efficiency, like that Q4 gross margin expansion, or the glaring existential risk you see from that 0.9 Altman Z-score and the hiring of those restructuring advisors. That's what you have to weigh as LESL tries to swim back to safety.